BBC wrote in 2013 that a person in a major Western city is exposed to as much data in a single day as someone in the 15th century in their entire life. That was in 2013 when cloud computing started to heat up. Nowadays, we have AI, which creates an even bigger data overload. Although it's tough to find supporting data, I found this chart which shows that the total amount of data generated has gone from 18 zettabytes, 18 trillion gigabytes, to 149 zettabytes in 2024. That's a 30% annual growth rate. Between now and 2028, that number is expected to grow by 1.6x. It's crazy if you think about how quickly data generation is. AI is now creating lifelike videos, writing entire essays within seconds, and mining data at a pace nobody thought possible. And it's just the start, if you ask me. I have spent a lot of time erasing noise, which is why I have a big picture strategy. I don't care about short-term market movements, near-term interest rate predictions, or anything related to making a quick buck or trying to get everything right. I care about the long term and finding opportunities that others overlook. I believe this is now more important than ever as the market has become a circus. We're dealing with so many trends and developments, most of which are directly related and impacting each other. This includes sticky inflation, horrible consumer sentiment, a stuck housing market, increasingly challenging employment numbers, and a ton of secular growth in anything related to AI. And gold has skyrocketed while the market trades at nearly 23.0x earnings. That's why important voices are getting louder. This includes Paul Tudor Jones, Ken Griffin, and others who have made some headlines in recent days and weeks. In this video, I'll focus on their comments and explain what this could mean for you and me, as I think most people watching this rely on prudent capital allocation to reach their financial goals. Many are convinced we're once again dealing with a tech bubble. On October 6th, legendary trader Paul Tudor Jones was interviewed by CNBC, who later went with the title, "Paul Tudor Jones says ingredients are in place for massive rally before a blow-off top to bull market." Essentially, the billionaire makes the case that the foundation is perfect for a strong rally, potentially much more explosive than the one the market witnessed in the year 1999. There are three things that PTJ noted. Massive returns in tech stocks. It's hard to disagree with that, as the tech-heavy QQQ ETF is up 18% year-to-date and up 25% over the past 12 months. It's up nearly 510% over the past 10 years. Even the ARK Innovation ETF is up nearly 60% year-to-date. Speculative behavior. I disagree with him here. No major indicator shows elevated sentiment, including the CNN Greed and Fear Index, the AAII Index, and the University of Michigan Consumer Confidence Report, which also asks people if they expect higher stock prices in the future. However, if we look at massive gains in stocks like AST Space Mobile, Rocket Lab, and others, I think it's still fair to say that sentiment is very bullish. Circular deals are worrisome. While I'm not accusing any company of any wrongdoing, I see his point, as companies in the AI space are all somewhat connected, which means multi-billion-dollar deals all end up benefiting each other. This is what Morningstar wrote with regard to the latest NVIDIA and OpenAI deal, noting in the same article that it does not expect this to be a case of a circular, closed-loop system. Quite simply, these are deals between two or more parties where funds are flowing back and forth. The most notable recent example is NVIDIA's NVDA partnership with OpenAI, wherein NVIDIA can invest up to $100 billion in the firm over time. The partnership can be considered circular, as OpenAI will likely buy gear from NVIDIA, which will reinvest those profits in OpenAI, which will likely use those funds to buy even more NVIDIA gear. The overview below has been shared a lot on social media. I believe it perfectly shows how connected the biggest AI players are. Moreover, there are big differences. While the valuation is comparable, in 1999 saw a U.S. budget surplus. Currently, the U.S. is running crisis-like deficits. This is one of the reasons why I believe the government will have an interest in keeping inflation higher for longer. It means using lower rates to kickstart cyclical growth, lower the real value of the national debt, and ease the pain of high deficits by stimulating nominal growth. I discussed all of this and more in this recent article, but more on that later. That's one of the reasons why PTJ isn't bearish just yet. While he believes in a blow off top, he also sees higher prices until that happens, which is why he's bullish on a combination of gold, cryptocurrencies, and NASDAQ tech stocks between now and the end of the year. PTJ isn't the only one bullish on gold, which may not come as a surprise, given that the gold chart looks like this. Ken Griffin, head of Citadel, recently made the case that the trend where people see gold as a safer asset than the dollar is really concerning. Essentially, he made the case that we are seeing de-dollarization and general de-risking of U.S. sovereign risks. Although I do not believe the dollar will see a weakening reserve status, there's some merit to his comments. The government shutdown has created elevated uncertainty. Both the deficit and the national debt as a percentage of GDP are at high levels. Rate cuts and dovish talk have created looser financial conditions. Moreover, as my personal view is that higher inflation will be accepted to get the housing market unstuck, kickstart cyclical/nominal growth, fund the data center buildout, and lower the real value of the national debt. I think gold makes for a great alternative to the dollar. While it may be a stretch to say that billionaire investor Griffin shares my exact thesis, he made the case that current stimulus is similar to what happens during a recession. Yet we're clearly not in a recession. That's why gold is so loved. It also explains why investors are perfectly fine paying a big premium for stocks. He also got support from yet another billionaire investor who most of you may be familiar with, as Ray Dalio made the case that this is an environment similar to the 1970s, when high inflation and economic instability were a huge risk. Back then, stagflation was a real risk. I don't see that happening, but he's certainly right when it comes to the toxic mix of inflation and growth risks. However, Dalio goes even further as he also made the case that the current AI trend gives him feelings of past bubbles, similar to what happened in the late 1920s when patent activity and technological innovation caused speculation to run hot, as well as the dot-com bubble. AI stocks are on fire right now, but let's be real, a lot of them won't survive once the hype fades. Like every boom, when the tide goes out, we'll see who's swimming naked. That said, ignoring AI would be a huge mistake. The impact it's going to have on the economy is massive. Companies like Walmart are already integrating humanoid robots, and over the next few years, everything will change. Critics say it's a bubble because adoption is slow and returns are weak. Studies show most companies aren't making money from AI yet, and even ChatGPT-5 didn't deliver the big leap people expected. But this is just the early stage. Real breakthroughs are expected around 2026. So how should investors play it? Focus on 3 areas. Big companies that use AI to boost efficiency, like Amazon and Walmart. Core AI providers like Microsoft and Google. Bottleneck players, infrastructure, energy, and cooling companies that make AI possible behind the scenes. Even Jeff Bezos called this an AI industrial bubble, but reminded us that bubbles also fund the real winners. The key isn't to run to cash or chase hype, it's to build a strong core, pick strategic winners, and understand the bigger picture. AI will reshape everything, and smart positioning now can pay off big later. Thanks for watching. See you in the next one.